I told you ledgers are boring. Well, good evening, everybody. It's a real delight to be here, and I'd like to thank thank you, everyone. It's a real delight to be here. I'd like to thank Chain Finance for organizing this evening. It's been an interesting road that we've all been on, I think, over the years. And what I'd like to do is just in my 10 minutes show you that things are probably a bit more real than people think. We hear the phrases proof of concept, use cases, and all of that, but there are actually people out there really using them, a couple here tonight for real applications, and I think that might change things. Our firm, Zien, has been running for about 20 years. We built our first blockchain, arguably, by anybody's definition, in 1995. And we built it for child abuse cases and the case management thereof. It's a still functioning system. So why do I say that? Well, it was mutual. It was a peer-to-peer system. It had sleeve cryptography where each thing was hashed into the next. And we had a validation mechanism. So I'm afraid, it's not that new. Even on the slides that Hans showed, arguably, Ripple had a ledger of similar form in 2004. And if you really start digging into the history, you'll see quite a bit. Now, insurance, as you know, is all about risk, and Hans and I are taking big risks tonight. It's also my 20th wedding anniversary. But I think, unlike Hans, I hedged my risk. I was married in Germany, so we had a civil wedding and we had a church wedding. And so we celebrated last night, or I wouldn't be here, Hans. I don't have your guts.
You didn't marry a lawyer, did you?
Okay. It's not... just trying to move it forward.
Oh, okay. I'll do it from my side.
That's great. So why am I excited about this tech? Well, oddly, I think I'm going to tell you a story that encapsulates past and distant future. Last July, around the time the cases that you saw there were finished, we were approached by a U.S. insurer. This insurer, in turn, had been approached by electricity companies in America, and they're talking about these differential pricing mechanisms. So if you allow them to turn your appliances on and off, you'll pay a lower electricity bill. They're exploring this. We've been exploring it in the electricity industry for about 30 years. But what they were saying was, how would you insure it? So you come home, and your freezer in July in Kansas is full of mush. And you ring your insurer, and they say, well, we see you've got one of these newfangled energy contracts, and I'm afraid you go and claim it off your electricity company. Well, the electricity company says, no, it's not us, you misinstalled it. You ring your installer, and they say, no, it's properly installed, and you might have cheated. You may have unplugged it that morning to hoover or vacuum, and you may also have, ready for this one, decided to turn frozen food into liquid assets, which does happen. There are fraudulent claims, as Hans pointed out. Now, in all of this, how are you going to do it? Well, of all the various announcements last year, the most important one to me was last July, IBM and Samsung saying they're going to put the Internet of Things on this. They do not see Ethereum or Bitcoin or anything. They see 7 billion people moving to 10, each of them with various ledgers. How are you going to do claims on autonomous cars? You've got signals whizzing around between automobiles, etc. And when there's an accident, you're going to have a claim. You've got to piece all of that together. You've got your home heating system, your entertainment system, etc., etc., etc. So I foresee, and I think they do as well, something like 150, 250 billion ledgers on the planet, all recording what's happening, because that's the only way that we can unpick these things to do the claims and the processing. Adam? So everybody's told you to look beneath the look beneath the Bitcoin and have a look at the ledgers. But the original paper, actually the term blockchain only emerges about April 2012. It's a variable, in fairness, in the original text by Nakamoto back in late 2008. But it just simply says you hash something one onto the other. So, sorry, one up again here. There you go. So what does it do? Well, the techniques are boring and old. And in fact, I want a boring ledger. I don't know about you. I'm not into kind of racy Lamborghini ledgers. I just want something really dull. I'm an accountant. It's really thrilling when it's dull. So what does it do? Well, the big thing is actually forget about all the tech you're going to hear tonight. If you go away, just remember what a central third party does. 3 things: validates, safeguards, and preserves. And the example I like to use is a shipping registry. Now, you're not going to believe this, but you can check it tonight. That boat is owned by my wife and me, and it's just out there. It's just on the other side of this building, so you'll see it as you go to the pub. It's called the Lady Daphne. It is for sale. So I want to put it on the Panamanian ship registry. How do I do it? Well, I go down there and I say, I've got a ship. They say, prove it. I say, oh, I got a really cool picture of it on my phone. And they say, no, we need a little bit more than that. Your Monitor Lloyd certificate, your load line exemptions, your proof of ownership, etc. Okay. And I want to sell it. I'm going to sell it to Adam. They say, that's great. I said, hey, actually, I had a cool idea. Could I sell it to Hans at the same time? And they say, no, it doesn't work like that. And the third thing is, I go, well, actually, it'd be a little convenient for tax purposes if you could just pretend it was owned by somebody else during this period. And they say, we don't work like that. Well, Panama's in the news a lot, and when they're not dealing with the Prime Minister, they're dealing with me. And I can hand them $10,000 and they will sort it all out, you know? Sure, nice ship. Hans and Adam, no trouble. And for another 10, while they're suing you in New York, we'll alter the records to help your court case. So that's the one way to cheat. But the other thing that happens with trusted third parties is that they create natural monopolies. And as natural monopolies, they get too strong and they become fat and they become lazy. And that's probably the thing to take away. What these ledgers are doing is they're taking away those last 2 bits. The preservation of the records can't be changed, and you're unable to handle the same transaction twice at the same time. Validation mechanisms, and I think Hans was right about that, are a key bit, and there's a lot of variety in that. But what they do is they prevent trusted third parties abusing power. So what have we done? Well, as you saw on the slide, we make them all work together. Another reason I don't think there's one true chain. We've always found we need some type of transaction chain. And for real applications, you're holding data and you need a content chain. Then for everything that we've done, we have something that deals with identity and something that deals with the market. We're already up to 4 chains. And so again, a different view of the world than I think you're probably used to. Now we have built anti-fraud systems for Suncorp. You saw Suncorp on the video. And we have built a whole bunch of identity systems. We have a big project going with PwC, several hundred people working on it. And what we're trying to do is to produce a portable user-owned identity system. It's up and it's running, and we're currently finishing off some of the applications on the phone, which with a bit more time, I'd have taken a picture. For those of you who are familiar with the insurance markets, we have demonstrated Accord messaging going back and forth for some time. For those of you who are interested in areas like timestamping, we have what's called Metronomo. It's a free timestamping system. There are 5 versions of it. They've been done with the states of Alderney. This sounds very, very basic, but you're going to be seeing, in fact, not a use case, an application. One of my clients is here tonight, SafeShare, and Cristiano will talk you through how they're doing that with the shared economy. I'd like to close on this little next 2 slides and then show where we're headed, and I'll be over. The first is, this is what's dominating some of the thinking in the Lloyd's market, TOM, the target operating model. And this is a slide of what it supposedly looks like today. You don't need to read the slide. It's a mess, right? That's what it is. And that's all I'm trying to demonstrate. But at great expense, the consultants have documented this, and EY and KPMG have been doing this for over a year now, I understand. And let's have a look at what they're recommending. So this is their target operating model in the future. And you see here in the middle, this service hub. Well, that's where the ledger fits. It gets rid of all the messaging. What you have is a logically central database that nobody controls. And why is that important? Well, because in the wholesale markets, we had LimNet in the 80s. We had electronic placement system in the early 90s. We had the great failure of Connect. We had the great failure of Project Darwin. These were all 80, 150 million failures, by the way. And then we had T-Mail. And now we're moving on to exchanging. We had RI3K, Qatarless, now maybe EBIX is going places. The reason is that nobody in the market wants to have a natural monopoly formed. and that's what they're trying to avoid. This technology, possibly for the first time, allows a mutual distributed ledger, which allows people to work together, but mutual means either owned in common or owned by no one, and that's what the market needs. And mistrust costs. This slide here lays it out as we see it. On the far right, you've got, if you trust somebody wholly, don't use a distributed ledger. Use a central database. It's perfectly adequate. If you trust absolutely no one, you're going to have the expense. Bitcoin, just to give you a little clarity here, it's currently 10 gigawatt hours per year. That's half the energy consumption of Ireland. It is, just to keep the trust system going. So somewhere in that space is what you're trying to do. And you're trying to do it, I think, ultimately for a few 150 billion ledgers. So ultimately, economics is going to matter at the end. And the economics are there. You know, on a pure Bitcoin, you're looking at 10 cents to 250 a transaction. Somebody's paying that. Ethereum is $20 to $5. We're doing systems for about a millionth of a penny or cent. People ask me which currency. I go, I don't really care. It's a millionth of a penny or a cent. And again, some of those times. So where are we headed? Well, in this sort of digital vellum, you know, you saw the Houses of Parliament trying to get rid of vellum and bringing it back. This is digital vellum. So we're working on things, for example, automated surveillance, which we have going of unusual stuff, heat maps, etc. We're trying to make them much more usable. But actually, the old technology is really quite old, and that's the way I like it. So when will we know this stuff is working? Well, I think it already is. We've got real clients. You may have seen the announcement on Monday that Blem, an excess of loss reinsurer, has moved onto our blockchains. These are not proof of use. These are not examples. These are not PowerPoint demos. You know, this isn't using the beta version of Ethereum. These are real applications out there doing real things, and they're really dull. Thank you.
Any questions?